Welcome back, everyone, to the Deep Dive.
Great to be here.
So today, we're turning our focus onto a giant, American Express, AXP.
Ah, yes, the card, the brand. Synonymous with, well, a certain status.
Exactly. And if you've been following the markets, you'll know the surface numbers look, frankly, pretty incredible.
Yeah, they got a strong run.
Right, AXP shares, looking at the figures up to October 20th, they're up about 18% in 2025.
Which is significantly beating the S&P 500.
Way ahead. And their latest Q3 results. Revenue, earnings per share both comfortably beat what Wall Street was expecting.
Good headlines, definitely. But those numbers, they're the result, not the cause, right? There's something deeper going on.
That's precisely what we want to dig into today. Our mission, if you will, is to get past those top-line figures, revenue, earnings, stock price,
All the usual metrics.
and really uncover the fundamental business metric, the engine that's actually driving AXP's success.
Yeah, we want to find that mechanism, the thing that gives them such consistent financial health, especially in a tough market.
We're looking for that core strength.
Exactly. Because when you see a company performing like this, especially in payments, which is super competitive, you can't just look at what they're making. You need to understand how.
Right.
The real aha moment, I think, comes when you realize AXP's power isn't just about volume. It's about something else, a unique way they monetize their users.
Okay, let's unpack this. So when we talk about that kind of unique advantage, the conversation usually turns to pricing power, doesn't it?
It absolutely does. Pricing power, that's kind of the gold standard, isn't it? It shows you have a really excellent business.
Define that for us quickly, though.
Sure. It's simply the ability to ask your existing customers to pay more over time and, critically, have them actually do it without kicking up a huge fuss or leaving in droves.
Some of the best companies in the world have that. But hang on, isn't everyone just raising prices now? Inflation's up, my Netflix bill goes up. Is AXP just riding that wave?
That's a really important question, and no, I don't think it's the same thing. Well, think about Netflix. They raise prices, and yeah, some people grumble, some might even cancel, because what they offer is, fundamentally, access to entertainment becoming more of a commodity.
Okay.
AXP is playing a different game. They operate in the premium access space. So the key metric we need to watch demonstrates real pricing power, not just, keeping up with inflation.
Gotcha. So what is that specific metric for AXP, the one we should be watching?
Okay, it's the average fee earned per active card, and you look at it on an annualized basis.
Right. So this is basically the membership dues, the annual fee people pay just to have the card in their wallet.
Precisely. It's the cost of entry into their ecosystem, so to speak.
And what's that number looking like right now?
Well, the number itself in the third quarter was $119 on average per active card.
$119.
Yeah. But honestly, the specific number isn't the most important part. It's the trend.
Okay.
This metric. It's been going up consistently, which shows, extraordinary acceptance from consumers for these higher prices.
How steep is that trend? Just how much have they been pushing those fees up?
It's pretty aggressive. The data shows that since the third quarter of 2020, so about 4 years ago,
Yeah.
that average fee per active card, it's climbed 72%.
Whoa, okay. 72%
Mhm.
since Q3 2020. That's huge.
It is. Think about that. Not 4 or 5% a year, almost 3/4 higher in just 4 years from the same customer base, essentially.
That's incredible leverage. So, for you listening, just to be clear, AXP is making 72% more money just from the access fee part of the business per card than they were a few years back.
Exactly right. Now, here's where maybe the financially savvy listeners might pause.
How so?
Well, you might know that the really premium cards, like the Platinum card, they charge a lot more than $119 a year, right? Fees can be like $695, sometimes even more.
Yeah, that's a good point. If I'm paying almost $700, how is the average only $119? Seems way too low.
It seems low because it is an average, and it's across all active Amex cards around the world.
Ah,
So that includes, the lower tier cards, the ones with no annual fee, maybe co-branded cards. There's a huge volume of those.
right. The mass market stuff dilutes the average.
Precisely. But, and this is the crucial insight, that massive 72% growth trend we talked about,
Yeah?
that's being driven almost entirely by the big, consistent price hikes on the premium cards, your Platinum, your Centurion levels.
Got it. So they figured out a way to massively increase the price on the most profitable products.
Yep.
And the sheer number of basic cards gives them a sort of floor, but the premium hikes are what's pulling that average fee skyward.
Exactly. It speaks volumes, doesn't it? about how much value those top-tier customers perceive.
It really does. It shows that AXP's most important customers, the highest spenders, the most loyal ones, they're completely bought in. They're willing to pay, well, almost whatever Amex reasonably asks for that access.
Which leads us right to the next question, why?
Yeah, exactly. Why? For most things, a 72% hike would have people running for the exits.
Yeah.
How does American Express get away with it? How do they justify these fees that just keep climbing?
Well, part of it is definitely the brand. The American Express brand itself is powerful.
Sure, everyone knows it.
But we have to look beyond just, brand recognition. Their whole strategy, their business model, it's built deliberately to target high-income consumers.
They're not trying to be everything to everyone.
Not at all. They're not really trying to grab the lowest common denominator in the credit card world. They're selling something else. Exclusivity, access, status.
So it's less about competing with Visa or MasterCard on, say, interest rates or how many shops take the card.
Right.
And more like competing with, I don't know, luxury travel agents or concierge services.
That's a great way to put it, precisely. And how they maintain that image, how they justify pushing those fees up and up, it comes down to what they give back.
The perks.
The perks and rewards. Really valuable ones. That's the core trade-off.
Yeah.
You pay this hefty fee, but you get a bundle of benefits that, at least theoretically, is worth more than the fee itself.
And AXP must be incredibly good at calculating the value of those perks.
Right.
They need stuff that feels super valuable and exclusive to the customer, but maybe doesn't cost Amex quite as much as the customer thinks it's worth.
That's the art of their monetization strategy, isn't it? They're essentially turning that annual fee into a curated package of luxury benefits.
Okay, here's where it gets really interesting, because there's a perfect recent example of how well this works. The latest Platinum Card refresh.
Oh yeah, that update was a masterclass. They really understood their target customer.
They did. So the refresh brought in new shopping credits, but they were really specific, targeted at brands and experiences that their, well, high-income, often city-dwelling customers value.
Things people were probably buying anyway.
Exactly. The sources specifically call out new credits for Lululemon.
Right, the high-end athletic wear.
And dining credits you could use at Resy restaurants.
Which are typically harder to get reservations, more exclusive spots.
These aren't just, get 1% cash back everywhere. These are status symbols packaged as financial benefits.
Absolutely.
But wait, isn't there a risk there? Focusing so tightly on brands like Lululemon, Resy, does that maybe alienate some wealthy people who aren't into that specific urban sort of aspirational scene?
That's a fair challenge, but I think the results show AXP knows its core audience incredibly well.
Okay.
The Platinum Card isn't meant for everyone, even everyone wealthy. By picking Lululemon, associated with wellness, quality lifestyle, and Resy linked to exclusive dining, they're hitting the specific lifestyle buttons of their target demographic.
Real tightly targeted.
Very. And the goal isn't just giving a credit. It's creating this mental synergy for the customer. They think, hey, I was going to drop $150 at Lululemon anyway, or we wanted to try that cool Resy place.
So my $695 fee isn't really $695 anymore.
Exactly. It's effectively reduced by the value of these things I was already planning to buy or do. It cleverly offsets the perceived cost of that big annual fee.
Minimizes the sticker shock.
Right. And the impact, we can see it directly in the growth numbers. That specific refresh, adding those targeted credits, it helped drive twice as many average weekly signups for new cards compared to before the update.
Double the signups. Just from adding those couple of lifestyle perks.
Double. 100% boost. It's stunning.
Wow. That is an incredible return on investment for AXP for those partnerships.
Yeah.
It really suggests they nailed the psychology, the perceived value versus what it actually cost them.
Absolutely. Because you can bet the cost to AXP for that Lululemon credit, probably negotiated at some bulk or wholesale rate, is less than the face value the customer gets. And that cost is easily covered many times over by getting twice as many new high-value members signing up. It dramatically boosts the lifetime value of those customers.
Okay, so when we connect all these dots, it really clicks into place.
Right.
That average fee, $119, growing 72%. It's not a deterrent.
No, it's the fuel.
It's the fuel for this whole premium engine.
Right.
The high fees pay for the cool perks,
which reinforce the fancy brand image,
which attracts the high-income folks,
who are happy to pay the higher fees, which funds the next round of even better perks.
It's this self-reinforcing cycle, a virtuous cycle. for AXP.
But that's the synthesis, exactly. That $119 average fee isn't just a fee. It's the lubricant keeping that premium engine running smoothly. Charge more, get the cash flow to offer more exclusive stuff, offer benefits that really resonate with your target's lifestyle and status, like Lululemon, like Resy, and they don't see the price hike as a negative. They see it as paying their dues for an exclusive club.
And you can see this working on the bottom line, too. The sources mentioned AXP's gross margin sitting around 61%. That's very healthy.
Extremely healthy. And that margin comes directly from running this premium customer cycle so effectively. They're collecting these fast-growing fees from customers who are generally less likely to default and very likely to spend a lot.
It's a powerful model.
It is. And if we connect this to the bigger picture, it does raise an interesting question about, how sustainable this is, how defensible.
What do you mean?
Well, we've established that this incredible fee leverage relies entirely on AXP finding new, desirable, and importantly, exclusive perks and partners.
Right. They need to keep the goodies coming.
And the bar keeps getting higher. They pulled off 72% fee growth in 4 years. To keep anything like that going, the perks have to feel even more valuable, even more exclusive next time.
Because if the value feels diluted or the perks start feeling commonplace.
Exactly. Or if the cost of providing those super premium perks starts eating into that nice 61% gross margin, then the whole ability to keep raising fees could stall out.
So they're constantly hunting for the next It's brand, the next status experience to justify the price tag. It's like a race.
It is a bit of a race. But for now, they seem to be executing it flawlessly. Consistently finding partners, like Lululemon and Resy, that deliver that massive boost in signups. It proves the perceived value is still way ahead of the perceived cost for their target members.
Which brings us nicely to the wrap-up of this deep dive. We set out to look past the headlines. The 18% stock jump, the strong Q3 revenue, and I think we found it. The real engine driving American Express. It's not just lending, not just transaction volume. It's that powerful, consistent fee leverage.
Built entirely on that cycle. Premium brand, escalating perks, loyal high-income base, higher fees.
So what does this all mean? Well, it feels like American Express has almost morphed into a luxury lifestyle company that just happens to offer payment cards.
That's a good way to frame it.
The fact that adding Lululemon and Resy credits doubled signups, that's crystal clear evidence they're selling curated access, not just plastic.
For sure.
And here's the final thought we want to leave you with. They pulled off 72% fee growth since 2020 by constantly upping the ante on perks.
Yeah, the challenge ahead.
Right. To keep justifying fee hikes, maybe keep doubling sign-up rates. Just how much more expensive, how much more exclusive do those perks need to become next year or the year after?
What's the next Lululemon, the next Resy?
Exactly. What new brands, what new consumer segments maybe do they need to tap into to keep that 61% margin looking good and keep that fee growth climbing?
The future of their premium model really hinges on who they partner with next.
Definitely something to think about. It really frames the challenge they face in maintaining that incredible pricing power.
Absolutely.
Great stuff. Thanks for diving deep with us today.
My pleasure.
We'll catch you on the next one.